Moving on to objective 4, account for accounts receivable. Now, so far, everything has just been pretty straightforward. Receivables, that's money that you're expected to receive, when it's going to come in. It almost seems like, well, you know, how much more do we have to learn about receivables? And the answer is not much more, but there is more. First of all, let's clarify what receivables really is. A receivable is a monetary claim against others, a legal monetary claim against another individual, person, company, entity, because we provided a product or service. And that our obligation of providing that product or service is complete, so therefore, we have a claim. Receivables are always considered to be, well, I shouldn't say always. In most cases are considered to be current because we expect them to be converted to cash within a year, within the year of the financial statement date. So if our fiscal year end is December 31st, 2020, and we're showing we have $100,000 of receivables, then what we're suggesting to you is that we expect to get paid by December 31st, 2021, okay? So within 1 year, we're expecting that money to come in. So we consider it to be a current asset. It'll convert to cash within 1 year. Sometimes they're referred to as trade receivables, and they are acquired by selling goods and services. And in some cases, receivables can be lending money. And when we do have that situation where we actually lend money to another entity, then we call that a note receivable. In most cases, when we do that, we're going to have somebody sign a note, a promissory note, to pay us back. The example here is a journal entries to record the receivables. You have a debit to accounts receivable. There's no dollar amounts here. We're just kind of looking at how the transactions occur, and then a credit to service revenue. In the previous section, this is exactly what we had done. And then when we lend money, well, we're going to loan somebody some money. We're going to give up some cash. We're going to give them some cash, whatever that is. That's going to be a credit to cash. And then we're going to debit the note receivable. This is money that we expect to get paid back. And that is an asset, something that we expect to receive in the past. We're also going to learn about a term, or these terms here, that's referred to as a subsidiary ledger. And a subsidiary ledger is detail of what your accounts receivable is. So in other words, your general ledger is going to have an account called accounts receivable. You've seen that already. In fact, here we had AR. I identified the specific person or entity or company in this example here. But in a general ledger, you don't usually identify who each customer is, especially let's say you've got thousands of customers. You're not going to be able to, you don't want to clutter up your general ledger with all these different accounts. So what you do is you have a total amount of accounts receivable, but that total amount can be broken down in detail to who those customers are. So we have what are called subsidiary ledgers. In the subsidiary ledgers, we have the specific customers and how much each customer owes us. So as an example here, you have Brown, that's a customer, filed that $5,000 is due, that's what's the balance, it's a debit, but it's on their specific account. FedEx has a $1,000 balance with us, and then Moody's has a balance of $3,000. So if I add the 5, the 1 plus the 3, the total is $9,000. Well, that total matches the grand total that's sitting on the general ledger called accounts receivable. We call this a control account, and then we have the subsidiary ledger that gives us the detail of that control account. We're also looking to managing and accounting for receivables. So companies risk not collecting some receivables when they sell on credit. It's just the nature of the beast. In some cases, we're not going to get everything. The risk of not collecting can be managed by running credit checks. So before you grant credit, before you sell to somebody on account, you want to make sure you do a background check. extend credit only to credit-worthy customers, separate cash handling and record keeping, keep a close eye on customers' payment habits, send second and third statements, and have customers sign agreements for EFTs, electronic funds transfers. These are all, historically speaking, methods that companies use to reduce the risk of not getting paid.